Thank you very much, and I'm honored to be with you here today. And as I was introduced, yes, I've been in-house counsel and out-house counsel with a large bank. But more importantly, and something that I'm very proud of, is that in 1995, I helped resurrect a small failing bank called the Hondo National Bank. It was at 16 million in assets and going down, and now it's more than 150 million in assets, and with 4 branches. And it's very successful. It serves small farm and ranch communities in southwest Texas, and it's doing very, very well. It's serving a lot of people on consumer level as well as the small business level. So I want to thank all of you for having me here today, and I hope that my words will maybe bring to light certain issues that are facing our country. I'm very pleased to be here with you. A very important and extremely timely issue, which is lending. The lack of access to credit and banking services for millions of American families, and what that says about the future of American prosperity. The problem that we face is truly daunting. According to a 2009 FDIC survey, approximately 9 million American households are considered unbanked, and another 21 million are considered underbanked. This means that 1/4 of American households either don't have a bank account or rely heavily on non-bank financial services. Many don't qualify for a credit card or a mortgage, so they have limited options if they need immediate financing. Compounding this problem is the extremely low national savings rate for American families. While the national savings rate has increased since the financial crisis began due to households pulling back, it has remained extremely low over the last decade, even turning negative at one point 5 years ago, according to the Bureau of Economic Analysis. And as I'm sure we will hear often today, a recent study showed that half of American families couldn't raise $2,000 in an emergency if they needed to. This combination of a low savings rate and the inability for so many Americans to access credit in a timely manner leaves millions of American households vulnerable to a financial disruption, whether it be the loss of a job, medical emergency, or other unexpected expenses. Everyone can agree that this is a problem. The big question is what can be done about it, and specifically, what should Congress do? From where I stand, the most important thing Congress can do is to ensure that we foster a vibrant financial services industry that offers ample choices to consumers of all income levels. Such an industry would be driven by consumer preferences and choices, and banks or other lenders would compete with one another for a borrower's business. One thing I learned in my many years in community banking is that when it comes to financial products, and specifically lending, you need to strike a balance when considering the needs of the consumer with the needs of the lending institution, whether it's a bank, a credit union, or a non-bank lender. If you tilt the balance too far in favor of the lender, ultimately the consumer loses because the lender may have an incentive to make a loan he knows might not be repaid. And if you tilt the balance too far for the consumer in the name of protection, again, ultimately the consumer loses because the end result is less choices and higher costs for the borrower. And this is my concern. That recent congressional and regulatory initiatives have upset this balance to the point that unless corrective action is taken, American families are going to be stuck with less choices, higher costs in the financial industry for a long, long time. And what Congress needs to recognize is that there is room for a financial economy for lenders of all different stripes. There's room for traditional banks, for credit unions, payday lenders, installment lenders, pawn lenders, or any other institution that offers a necessary service for that customer. And inherent within a vibrant system that allows different types of lenders to participate and compete is the ability for consumers to graduate, so to speak, from one lending class to the next. For example, payday lending is certainly not appropriate or cost-effective for every American family, but it might be the only option available for a lower-income family who has an immediate need for cash. That family can then use payday lending for a period of time, and if their income and savings were to increase, they can then move forward and begin to use more traditional banking products, checking accounts, credit cards, and mortgages, etc. In this example, the needs of the consumer, the needs for the lender are in balance. While the family may not necessarily like paying higher rates for a payday loan than they would on a credit card, it's their only option. And the fee the payday lender charges is the necessary incentive to help them make that loan. What concerns me is that there is no longer a natural balance between lender and borrower in the financial services industry, and that consumers are now going to be placed into a box when it comes to lending products with little chance for upward mobility. Recent legislative and regulatory action has served to restrict credit to millions of Americans, and it has forced even more families outside of the traditional banking system. For example, well-intentioned but misguided legislation aimed at regulating credit cards could potentially force millions of Americans who would otherwise qualify for a credit card to borrow from higher-cost lenders such as payday or even loan sharks. A new rule regarding swipe or interchange fees has already forced a number of banks to begin charging fees or requiring minimum on accounts that used to be free. This will have a direct negative impact on low and moderate income families, exactly the people who need to be brought into the banking system. And Congress has created a new federal bureau that has the potential to restrict credit and banking access for even more Americans. A stark example of trying to tilt the balance so far in the name of consumer protection that ultimately the consumer has less choice and higher costs. Congress nor the American people should be surprised when data shows that these recent actions have perverse consequences on our economy and on the ability for low and moderate income families to access banking products and credit. More importantly, these actions will directly affect the mobility of consumers within the financial services sector. Last spring, in a letter to shareholders, J.P. Morgan CEO Jamie Dimon announced, "In the future, we no longer will be offering credit cards to approximately 15% of the customers to whom we currently offer them. This is mostly because we deem them too risky in light of new regulations restricting our ability to make adjustments over time as the client's risk profile changes." This is the exact opposite of what Congress should be encouraging. Strict and proper regulation and transparency is absolutely necessary. However, when congressional actions go so far that they completely shut off a group of Americans from obtaining a credit product, it becomes a great threat to the future prosperity of our country. American families are not being protected when they can't obtain credit, or when their only option is to borrow money at higher rates than they would otherwise be able to borrow. Instead, they are being denied the opportunity to enter the mainstream banking system, save money, and build up a credit score that will benefit them in the long run. The financial services sector is the engine room of our economy. And right now, the engine is stalling for businesses and for millions of American families. The only way to get out of our current predicament is to foster a financial economy that is full of choices and where lender and borrower are able to meet on equitable terms. The sooner Congress realizes this, the sooner we can help our economy recover and grow opportunities for our American families. Thank you for being here and for inviting me to speak here today.
The Congressman will take questions if you have any questions for him. All right. Well, if you don't have any, I can certainly start with one.
Okay.
A few years ago, the Congress passed the Warner Act, which essentially prohibited payday lenders, title lenders, and tax refund lenders from making loans to the military. If you were in Congress, would you have voted for that bill, and what, if anything, would you do about it now?
Well, I think that it needs to be restudied. I think that sometimes our military, especially as they're going overseas and fighting our battles overseas, need extra protection. I think that sometimes coming within the sphere of what I said earlier, we need to make sure that we have a balance of available credit for our citizens so that they have these opportunities. And as we try to protect our servicemen and women, many times we may go too far and shut them off of that very important credit that they need for their security, so that when they leave their families behind, they will have less access to emergency funds or other facilities that could ease their deployment as they are serving our country.
I was wondering if you had any comments on the price controls that are about to go into effect on the interchange fees and what you think some of the effects of that are.
Well, first and foremost, I want to start out with a story. I had a group of restaurateurs and other merchants that came to me and said, you know, we want you to support these interchange fees. And I recall that one restaurateur told me that for his signature drink, it cost him 98 cents to make. But yet it was bringing a lot of revenue because he charged $6 for it. And, you know, that's the free market, and that it works for him, and that's a tremendous boon for his business. But by the same token, I told him, how would you like it if the federal government were to come in and tell you you cannot charge more than $1 for that drink? And he says, oh, that's a different story. It's not. And I think that when we talk about interchange fees, we're talking about price fixing under the Durbin Amendments. And I'm very much against price fixing. I think that the consumer is the person who sets those prices, depending on what the camel will bear or what the horse will bear in any given condition. It's not because I'm for banks or against restaurants and merchants. It's because it's the fair thing to do. It's not fair to fix prices in an otherwise free economy. But I think that what it's going to do, ultimately, is that it's going to put a huge burden on the ultimate consumer, because he's going to be paying more or being driven out of his checking account or credit card or swipe card account simply because the costs are going to go up. Those are ultimately going to be passed to you and me. Yes, ma'am.
Congresswoman, when someone walks into a community bank and needs an $800 loan and they have a FICO score of 580, is it really possible for the bank to extend them a loan? Is it really possible for, with the capitalization requirements, for a banker to really be able to serve that need?
As a community banker, I will tell you that under the community banking scenario, FICO score is there and it's important. But what is ultimately more important is, how well do I know you? How true to your word have you been? You may have had some rough time, but I know you, I know your proclivities, and I know that I can bank on you, so I'm going to extend that $800 line of credit to you. I think that what we've been seeing in these days, because of the amount of uncertainty and the enormous amount of uncertainty that has been created by the Dodd-Frank bill that was passed a year ago, a little more than a year ago. And because of all of the rules that are being proliferated now, many bankers are afraid to lend, and to lend those $800 even to Joe Blow that they've known forever, and they know his habits, and they know that he's a good businessman. And on top of that, you have many agencies that are breathing down the neck of many of these community bankers, telling them, if you make that loan, despite the fact that you know Joe Blow and you know that he's good for it, I'm going to force you to mark it down and take a hit to your bottom line. So because of that, credit is frozen. And Joe Blow can't walk into the bank and ask for those $800. Yes, sir.
Congressman, you're dead right when you talk about the trade-offs between different policies, and that's true on almost any policy one has. But we came from a system in the up to 06, 07, it was one of the most deregulated financially in decades, and it had a massive impact on the financial system and stability, and indirectly on people who lost around the country because of it. So I'm wondering if Dodd-Frank was not the answer, how do you know what the right balance was? What should Dodd-Frank look like? What should have been regulated?
Well, first of all, philosophically, I respectfully disagree with you. I do not think that we were under-regulated prior to Dodd-Frank. I think that there may have had to have been some tweaks in our financial system and our financial controls from FDIC, Office of the Comptroller of Currency, and others. But it was an act of over-regulation that was introduced by Dodd-Frank. And from my opinion, having read most of Dodd-Frank, it was written by people that didn't understand the financial system of this country or its economy. And as a consequence, it has put a tremendous chill on the ability of people to get credit and to move this economy forward. If we look at the sources of what happened in March of 08, it was a huge bubble. And it was a huge bubble that was created over time, mainly due to a variety of factors, all under governmental control. And I think that because governmental control manipulated the financial system, because it is under government control, and with Community Reinvestment Act and Fannie and Freddie saying, don't worry, I will guarantee, a bubble was pricked and it burst. And panic ensued, and in the wake of that panic, many knee-jerk reactions were put into play, and as a consequence, we had Dodd-Frank. That's my opinion, and that's the way I look at it, and I've been following this since the first time that we knew that a bubble was there, and it was going to burst. And there were many other factors that caused it to burst. There was over-speculation in the real estate market, there was a drive-up on prices and everything, and as a consequence, many people were buying real estate, especially home ownership real estate, banking on the idea that it was going to jump up another 10 points or another 20 points. And with the Community Reinvestment Act and forces there, well, it was easy to make anyway. Fannie and Freddie were guaranteeing it, therefore folded into mortgage-backed securities. Sir?
Congressman, you talked a little bit about getting to equitable terms for lenders and borrowers. Are there other, I'm sorry, can you hear me?
Yes.
You talked a little bit about getting to equitable terms for lenders and borrowers in your comments. But I wanted to know if there were other terms or requirements that you were thinking about other outside of pricing that would help out.
Well, a lot of times you have so much paperwork involved that is just downright frightening to anyone that walks into the bank and says, I'm a first-time borrower, I'm a first-time homeowner, or attempting to become a homeowner, and you have a stack of paper this high that asks you down to your underwear size. And things that, cause an enormous amount of consternation as you're trying to fill them out. And I think if we make them a lot more friendlier, we can still protect the lender as well as protecting the borrower, and making sure that people approach credit in a more friendly manner.
We have time for one more question if anyone has anything for the Congressman.
Well, I see by no more questions that I've really fully answered all of them. I hope that I've been helpful to you, and I thank you very much for listening to me.
So we're going to get started with our first panel, the availability of credit in the current economy. Recent studies show that half Americans cannot raise $2,000 in an emergency, as the Congressman just indicated in his remarks. So there's no doubt that America is facing a credit crisis. The panelists here will examine the scope and the magnitude of that crisis. And we're going to start off with Joanne Young from the RAND Corporation, Michael Flores from Bretton Woods, Inc., and Jerry Guzman from the Consumer Rights Coalition.
Thank you very much, Suzanne. As you mentioned, my name is Joanne Young. I'm with the RAND Corporation. But I'm really here today as a representative of the Financial Literacy Center, which is headed by Dr. Anna Maria Lusardi, who could not be here today because of other engagements. The Financial Literacy Center is a collaboration between the RAND Corporation, Wharton, and Dartmouth College. It is a center with almost 19 projects today studying various aspects of financial literacy, how they impact financial decision making, and their effect on long-term savings behavior in the American population. The paper that I'm going to be talking about today is a paper written by Dr. Lusardi, her co-authors Daniel Schneider at Princeton University and Peter Tufano, now of the Said Business School at Oxford. It is the paper from which the key statistic that has been cited, I think, many times even this morning comes, and so I think all of us will be very excited to see the analysis. I would also like to mention that at the present moment, these statistics are from 2009, but we are working on updated statistics for 2011, so do keep your eyes open in the future for more studies coming this way. So again, just to preface, this is work coming from the Financial Literacy Center, and any questions I'd be happy to answer, and if I can't answer them for you today, I'll direct you to Dr. Lusardi. So what does this paper do? Firstly, in this paper, Dr. Lusardi and her co-authors propose a new, broad measure of financial fragility in the United States. And they document a very, very shocking, I think, level of financial fragility among typical American households. Secondly, they document how American households cope with shocks. So not only is the research telling us the level of insecurity in the economy, but they're also trying to get at what American households are doing to cope with the types of exogenous variation that we're seeing in the financial crisis. And the last thing that the paper does is try to do an international comparison of financial fragility to see where the United States, from a macro point of view, sits among a group of comparable peers. The data for this study come from an international survey conducted by TNS Global, one of the leading market research firms internationally. TNS Global did a survey of over 9,200 households, approximately, across many different countries in the developing world, one of which is the United States. This survey was conducted mostly online. It is a voluntary survey and conducted during the year 2009. In this survey, Dr. Lusardi and her co-authors introduced this new measure of financial fragility. It is a broad measure of households' ability to cope. Now, the interesting thing about this measure is that it's not an objective measure in the sense that it doesn't measure in any sense a level of assets or a level of income, but instead it tries to get at what households themselves perceive to be their ability to cope. And the measure, as we've heard again several times today from the Congressman and others, is the very simple and straightforward question. The question that was asked to households in these different countries was, how confident are you that you would be able to raise $2,000 if an unexpected shock came your way? Within the next month, this number was adjusted across the different countries in the United States to $2,000 US. The response to this question, even among households of fairly high income, is really, I think, very surprising. What the study suggests is that over half of all American households answered that they cannot raise this amount of money if a shock were to come their way in the next month. I want to sit back and think a little bit more about this very simple statistic. What this means is that, first of all, households on the very high level of the income spectrum also are subject to this shock. They may not be able to cope with a very simple thing that we might consider. They may not be able to cope with unemployment. They may not be able to cope with a medical emergency or even a car accident. May not households that we think of as financially secure based on income off that pedestal of security. The second thing I'd like to note is that this is a measure that was conducted in 2009. Almost certainly in 2011, these numbers will be worse. The third thing to note is that this number is derived from a survey conducted over the internet and weighted again to match the American population. If anything, if we think that people on the internet are a little bit higher income than the general population, if there's any bias in this number is almost certainly biased upwards, which means that this picture is almost certainly, if biased at all, biased in an optimistic direction. Which means that the severity of the problem, in some sense, if we step back and take a look at this number, really represents a lower bound of what we might think of as the state of financial fragility in the American population. Why is this the case? Today is a rainy day, so I suppose it's appropriate that we talk about emergency funds. A different study on which Dr. Vasardi worked, the 2009 FINRA U.S. Financial Capability Study, suggests that, again, almost half of all Americans do not have a rainy day fund at all. Further analysis of the results of the survey tries to get at who, in fact, are the people who are most financially fragile. And so we have Dr. Vasardi and her co-authors employ multivariate regression techniques to try to piece apart the determinants of financial fragility. In other words, what they do is try to account for financial fragility by running regressions of all of these factors simultaneously. What they found is that, if you look at the slide carefully, that controlling for all these factors at the same time, it's not surprising that we find people with higher wealth are less financially fragile, people of higher income, people of higher education, and people who have very recently not very recently experienced a loss in wealth. The unemployed are also more financially fragile. These are all things that I think are not at all unintuitive. But what's really interesting is that if we look at the bottom of the slide, that financial literacy is really an important part of what makes people financially fragile. People who have experienced some form of financial education are significantly less likely to state that they are unable to raise that money, conditional on all these other demographic variables. So conditional on income, conditional on wealth, conditional on formal education, financial education and financial literacy make a difference to people's financial fragility. The study further asked about people's coping strategies. So the question that was specifically asked in the survey was, if you were to experience a shock of this kind in the next month, how exactly would you get the funds that you need? And this was only asked for people who said that they did have some capacity to raise those funds. They were allowed to select up to 3 ways out of 14 options that were presented to them. These 14 options covered a number of different coping strategies, but were grouped into a set of different groups. So the first category is whether or not you in some way expressed that you would employ a strategy that drew down on your private savings. As you can see from the slide, this included options such as draw from my own savings, liquidate or sell my investments, liquidate my retirement savings, or borrow against retirement savings held at my employer. The second group of coping strategies we categorized under the broad heading of utilizing social networks. So to what extent people would report things like reaching out to their family and friends. The third category was accessing mainstream credit. So the things that we have been discussing today, going to a bank, taking out a loan, or applying for a credit card, applying for a second mortgage. The fourth category was accessing alternative credit. So the degree to which people reported that they would go, for example, and seek a loan from a payday lender or pawn some of their belongings. Finally, there was a group of strategies that were asked about that included increasing work effort. So asking whether or not people would go out and try to work more days or delay their retirement or get a second job. Finally, people were asked about whether or not they would sell assets. So whether or not, for example, they would go out and sell their home to try to meet this unexpected shock. What the paper tries to look at is, first of all, the extent to which there is a pecking order among these strategies. What the results show is that many people will draw down on their own savings first. But another surprising result is that most people will try to employ multiple strategies. So not only would they try to get money from themselves, but they'd also try to go to their family and friends, and in some cases explore alternative credit mechanisms. What Dr. Lusadi and the co-authors are exploring in this work and other work is the notion of a pecking order. And the concept is fairly simple. It's an idea I think that's very intuitive to most of us. The idea being that when a shock hits a family, what will first happen is that people will draw down on their own resources for various reasons. One reason is that this is the cheapest thing to do in terms of transaction cost. It's also the most familiar thing to do, and it's the least risky. So in terms of what we think of as a pecking order, the initial response would be to draw down on your own savings and then to reach outwards to your family and friends. Like the firms, what households will do is first explore internal options and then go on to try to access formal credit markets. After they try to access formal credit markets, depending on relative cost, they may then go to alternative financial providers. What this means is that the need for, as the Congressman referred to earlier, a rich and vibrant financial environment that offers different options to households is really very important if we want to ensure that households are able to follow the strategy that they would most desire. Because if these options are cut off or we interfere with the relative cost, this is really going to dictate the strategy that households ultimately follow when they are faced with a shock of this kind. This pecking order theory actually offers a number of testable implications for future work that we hope we'll see explored in the studies that come from the FLC. The last thing that I do want to touch on is that the study also offers some comparison between the United States and other high-wealth countries. In addition to the United States, we explored data from a number of different countries, including Canada and a number of the OECD countries that might be familiar to you. I think we can just go on to the next slide. What this bar graph shows is the number of people answering the question about coping and the different categories. And what I'd like you to do is really just focus on the blue bars. What the blue bar shows right there is the fraction of people who report that they are certainly able to cope. And if you look at where the United States is, it is all the way on the right side of that graph. So even relative to its peers, the share of people in the United States who report that they are certainly able to cope is almost at the bottom of the spectrum of this pool of countries. And again, this is 2009. What the paper tries to do is examine differences across countries. There are only 8 observations on a macro level, so it's impossible to do any kind of meaningful statistical analysis. But what the paper does show is that, first of all, these differences are not completely explained by individual level observations or individual level demographic differences across countries. It's not related, for example, to PPP differences, and it's not related to levels of poverty or unemployment. It's not related, very interestingly, to the level of the social safety net across these different countries, which are quite diverse in their different social systems. And finally, it's not related to measures of financial development. So where does that leave us? It leaves us with a little bit of a puzzle internationally. It leaves us with a lot of research to explore, both on a micro level and a macro level. And it leaves us with a very pressing need for more recent data to try to understand where we are today in 2011, both within the United States and relative to our peers. What we know is, just to recap the findings for the audience, that there are high levels of financial fragility in the United States, really at a shocking level in 2009, and unclear where we are today in 2011. Several rich countries are financially fragile, it's not just the United States, but we really need to go beyond the traditional theories that we have about precautionary savings and look at many different factors. We need to look at the financial environment more broadly to try to understand how people cope with financial shocks. So again, any questions, I'm very happy to answer. If there's anything that I can't answer personally, I will turn to Dr. Lusadi for the reference. But thank you very much. I'm very happy to have been here today.
Good morning. My name is Michael Torres. I've been working in the financial services industry for well over 30 years and advising banks since 1981, actually coming up on my anniversary, October 1st, where I started consulting. Given that, my work not only involves analytical work and research in terms of consumer credit and why we're here today, but it also is hands-on in terms of what I've done with banks throughout the years. I've been through several of the downturns, all the way from the initial round of deregulation, which inevitably caused the S&L crisis when their funding costs floated against their asset prices that remained the same, to the various real estate slumps that have hit, and most of those historically were more regional in nature than what we're experiencing right now. The oil prices slump that we had in the late 80s, early 90s. But again, these were more focused regionally. This is one of the first, or this is the first crisis that I've been through that's systemic and impacts everybody. Consumer credit. Why are banks really not the source of small dollar consumer credit? Historically, I advised banks probably since 1990 of minimum loan amounts. The cost of delivering and individually underwriting a loan with the loan officer, the underwriter, the processor, the closing, the funding, and the servicing of that loan. We went through various calculations and said, what should your minimum amount be? I just revised this a few weeks ago in response to an article that came out. And I'm looking at right now, very conservatively, because I did not add overhead allocations or anything else, at $1,500 is the minimum amount that a bank can individually underwrite and process a loan. Most demand for short-term, low-dollar loans are under $1,000. You look at the FDIC small dollar program, their average loan amount was $724. Again, well under 50% of that minimum that I suggest banks cannot lend and make money. The other issue is the bank's cost structure, the business model, if you will. For the majority of banks in the United States, their business model is based on a 20th century model. It's based upon brick and mortar. It's based on branches where you have telelines that were designed before we had electronic banking, that were designed for people to come in, deposit checks, cash checks, make loan payments. That is not a viable model anymore. You cannot make the switch immediately to a pure electronic environment, but the problem is, during this transition time, it's very difficult for the banks to find a profitable model. How did they deliver consumer credit profitably before this? Home equity lines was a way. You underwrote it one time and you let the consumer decide when they want to draw against that and pay back against it. There's no more involvement from that bank, so they could offer that. Well, there's no home equity left for people to draw upon. What was the other one? Credit cards. And a lot of community banks, most community banks did not issue credit cards. They were called what we call agent banks, but they offered credit cards to other major issuing banks. And that allowed access to consumer credit. Obviously, it got to the point where most people maxed out their credit cards. What was the third source? And to me, this is a source of unanticipated credit needs, and that's overdrafts. Overdrafts have received what I think is a bad rep. In some instances, in one instance, it's a deserved bad rep. And let me explain that. In the late 90s, I started installing overdraft programs for banks because consumers were being charged for bounced checks. There's no value in returning a check because they got hit with the first charge, the NSF charge. Typically, the merchant or whomever would redeposit that item. If you had insufficient funds again, you had a second charge. If that check was made payable to a merchant, each state has their own fees for the merchants to charge a return check fee. Or if they made it for rent, you would have a late charge, or utilities, you might have reconnect fees. Nothing good happened when you returned a check. So paying checks into overdraft was a service. I'd rather pay $30 and have it paid than pay $90 and have it returned, $90+ and have it returned. Where I think we went off the rails is when we started opening it up to debit card transactions. We started charging $35 for a $22 debit card overdraft. I don't see the value. But you look at what the market is saying right now. Look at the level of opt-in from consumers who say, yes, I want to have access to paying my debit card transactions into overdraft. It's remarkable. It's a lot higher than I thought it would be. But again, getting back to the access of credit. Since the last 3 years, round numbers, and just for commercial banks, you can add about 15% when you add in credit unions. But NSF overdraft fees in 2008 were $29 billion, or $29 billion, excuse me. 2009, they were almost $31 billion. They went down to $27 billion in 2010, and I'm forecasting it to be $24.7 billion this year. A variety of reasons. Number one, people don't have a lot of money. People are not writing the checks. The economic conditions are driving a lot of that. But again, what's driving a lot of it too is Reg E, and banks saying, no, they're pushing back. And banks saying, we're going to start charging you for these free checking accounts now. That was what supported free checking, were the overdraft fees. You look at what banks are charging. Citibank just came up with a 25% increase to $10 a month for their basic checking account. That's pushing people who, that was their lifeline account, out of banking services and into an alternative financial service provider, and that specifically are prepaid cards. But what's their option for that short-term credit need? It used to be drawing on the home equity line, it used to be credit card advance, it used to be overdraft. Now it's alternative financial services. 3 to 4 banks are testing the waters with a deposit advance program, similar to a payday loan. They say, we'll charge you $10 for a $100 advance, and it's due within a month, which is a little misleading because that's 120% APR. The problem is, it's paid in your next deposit. So if I took that advance today and I get paid Friday, that's 4 days outstanding. That's a significantly higher APR. But I don't think APR is the right way to go, and the next panel is going to get into more detail on that. I mean, think about the value proposition. Let's say I had that $100 advance for 2 weeks. So that would have been about a 240% APR the way we have to disclose now. $10 cost for a $100 advance. And I understand time value of money, but follow me on this one. Think of when you say, I'm only paying 5% on a mortgage loan. What a great deal, 5% APR. Over the life of that loan, if I hold it for that long, I'll pay $93,000 for a $100,000 loan. But I'm only paying a 5% APR. Either way, that APR is not a clarification to the consumer. It's certainly not a clarification of what the true cost is of that $100 short-term advance. And it's really not telling them in hard dollars, what am I paying for that mortgage over 30 years? So I suggest we need to come up with another way to provide disclosure and clarification to individuals going forward. Now, let me touch a little bit more on that minimum loan amount. When I looked at that, things you have to consider, and I looked at the FDIC small dollar program, only half the applications actually were converted into loans. So you still had people, loan officers and underwriters working the loan, and only half of them converted to loans. I took those costs. I took the cost return on allocated capital for that loan. I said the funding cost was maybe 1%. I can give you details if you want later. I won't put you to sleep with it all right now, but the point is, when you added all those costs in, interest expense cost, capital allocation cost, return on capital, direct cost, and that's assuming 100% capacity for these individuals, which most loan officers and underwriters aren't working at capacity right now, it was $700 some odd. So in order to recoup that, you came up with that minimum dollar amount. I'm looking forward to the rest of this session. I think we really need to look at who is going to provide the solutions for the customer? We're looking at a regulatory-driven marketplace right now that is in fact taking product off the market. Banks with Dodd-Frank, and I've worked with several banks that have made part of their loan policy that they will not offer loans to high-risk customers because of the penalties associated and the reporting requirements, particularly on small business. They're having to do HMDA-like reporting, Home Mortgage Disclosure Act, gathering all the demographic information for small business loans if it's a high-risk borrower. So they're saying, we will not lend to high-risk borrowers. We've cut off credit. Versus what's a market-driven option? Who is servicing? There's credit available out there. The banks that try to deposit advance program. You've got payday programs out there, both storefront and internet. You've got pawn, you've got title. These are options that are available. And I agree with our first speaker about there's a life cycle. Not one solution works for somebody their entire banking needs career. So I think we ought to look at what is an appropriate market-driven solution. Regulations, yes, for the bad actors, but don't paint it with a broad brush. People are not stupid. The consumer is not going to buy a product that doesn't fit their needs. There are too many options available, and the more we regulate, the fewer options we're giving that consumer. Thank you. I'd be happy to answer any questions.
We had to not have as many employees on our payroll. We had to let some people go. I am a small business, and we restructured, and there was really nobody to turn to.
Where I was living, I was pretty far away from family, and I didn't really have too many friends who would have been willing to lend me that large amount of money.
I spent 1 year and 1 month locating a bank. It took me so long to compile this information, and it took them 10 days to just send me a typed piece of paper saying thanks for building. Tried to go to the credit union. A couple of friends had said that the credit union might be a better option, and I wasn't able to get along there either.
I so happened to see an advertisement on the internet.
I went to one of those cash advance fees cash. I've borrowed money a couple of times from the payday lenders. The first time, I think it was about $200, and then the next one I think was $300. I had to pay my car payment, and just so that I wouldn't be late, or pay late fees. Also, instead of bouncing a check, I had to do that.
Well, I had to worry about mortgage and light bill, water, all that stuff, because I had to take care of everything at the time. So I think everything would have kind of spiraled out of control without them.
That's why I think it's important that these options continue to be available for people. Working poor, single moms, sometimes we just don't have those options. And even, I'm a college-educated business owner now. At that point, I was, just facing some really difficult times, and I think it's something that folks should have access to.
I could very easily add my story to that video. Homeowner, married for 27 years, and I had just recently gotten a divorce, and I decided to take a leave of absence when my mother had been diagnosed with Alzheimer's. I became her primary caretaker. And while I rented my home to move in with her, I had an emergency that was a little bit more that I had put aside for, budgeted for. And ultimately, when weighing my options, even though I've been a credit union member for 30 years, the only option I had really that was reasonable and going to fit my reality that day was a payday loan. My story and these stories aren't different. We hear them every day. They're communicated to legislators and lawmakers and policymakers through our website, through our membership, mobilization. And we find every day that consumers just really want, what they really just want is options. They want to be able to make their own financial choices, and they want to choose from a variety of options that works for them in their situation. Speaking of Congress, after testifying at a congressional hearing, while at the time I was the only person on the panel who was an actual consumer advocate who had used an alternative financial product, at that hearing, also present were many members of alternative financial industry, consumer advocates, and we began to talk. That was actually the conceptual idea of Consumer Rights Coalition. We began to talk about an agency that would mobilize consumers to use their voice on what they need today in the credit market. Access to credit remains one of the essential elements of any successful community, whether it's personal, commercial, or community development credit. Regulatory and legislative changes must provide for increased access to a broad range of appropriate credit sources and financial services. I represent the Consumer Rights Coalition, as I stated before. We are now 200,000 members and growing. Consumers who have bank accounts are working but choose to use alternative financial products to meet their household demands and challenges. Our members have traditional bank accounts, as I stated, but they don't always have that safety net. And I'm not talking about a 401k. I'm talking about, as we stated before, a minimum amount of money, whether it's in a savings account, in a shoebox, or underneath a mattress. And again, they want to preserve their access to a full range of credit options and other basic financial services. And they want to just really have the choice. I think it comes with human pride. They want to have a choice to find their own solutions to their own household problems. A recent study, I think it was already stated in the Wall Street Journal, found that half of Americans would not be able to get $2,000 in a month if they needed to. And another recent study shows 64% of Americans do not have $1,000, as I stated, in a savings or anywhere else. According to a recent FDIC survey, 21 million American households have bank accounts but rely on non-bank financial services by choice. The fact is that right now, even if they went to a traditional bank, underbanked consumers find that the bank does not have the product they need, which is a short-term, small increment loan. They don't have that. Say even at $300, they can't offer something at $1,000 or $2,000. And as we heard from the small business owner, that's exactly what she needed. On the other hand, we'll hold on the slides for a minute because I think we're off just about one. In the previous slide, you saw that while 73% of banks are aware that of the significant underbanked and unbanked populations in their communities and their market areas, less than 18% of banks state expanding their services to those communities, those banking consumers, in their business strategy or as a priority. When asked to rank the challenges banks face when serving or targeting unbanked or underbanked individuals, they state profitability issues, regulatory barriers, and fraud concerns. Some banks, mostly when they're government subsidized, are beginning to compete in small dollar short-term lending market, and that's really good. We feel at the CRC that competition is better. It drives prices down, and the more people offering a product, the more choices our consumers have. Consumers will benefit, the more companies offering services, and again, it'll create a competitive market. People are looking for greater convenience and less cost. For example, I meet young people every day who strictly bank by phone. I find that extremely challenging, but it works for them. Their phone is their checking account. Whether they're offered a bank or non-bank option is irrelevant to them because the technology is driving their choice in the competition. Some would prefer cashing checks at a check cashing storefront rather than at their bank so they can access their funds immediately. Others are even transferring money with iPhone apps or via text. Rather than regulating the services of non-bank lenders out of existence, let's focus on ensuring that consumers are protected throughout the transaction by requiring full disclosure, clear and truthful advertising, refinancing limits, extended payment plans, and federally compliant collection practices. These are critical to ensure that the consumer is protected. The bottom line is that more Americans are coming up short from time to time. Policies and regulations that limit credit options are forcing consumers to find short-term cash in other ways. And we find that it usually is an option that costs more and damages their credit. When you damage a consumer's credit, you think of it as the individual, but eventually it impacts entire communities and neighborhoods, especially in already traditional marginalized communities. To truly protect consumers, we all should be working towards balancing consumer protections with continued access to a wide variety of responsible credit options for all Americans. I can't say that enough. All Americans need access to responsible credit in order to build strong financial records, healthy credit ratings, the more traditional banking system opportunities they have, the more they will be willing to work with the traditional banking system. And ultimately, they will build personal wealth, which means community wealth. Thank you very much for your time.
Okay. Thanks to all our panelists. We can open this up for questions, and I can start things off with a question for Mr. Flores. You had indicated that your research suggested that sort of a minimum loan amount would be $1,500. That would be, eligible for, offering by a depository institution. And I just wondered, could you go over what the price point on that would have to be, and whether that would be below the sort of typical 36% usury ceiling?
That was. I took the FDIC result from their small dollar lending program, and it was a 13% APR. They $724 principal advance, 12 months, and again, that's what I backed into. If a bank was to be able to offer that same dollar amount over the same term, what would they have? Let me back up. To do that, they could not do it profitably because they ended up with a loss. You considered all-in cost with the loan originator, the processor, the underwriter, the servicer, and of course the ongoing 12 months of servicing that loan. So to back into, when I looked at that net loss, what would that minimum loan amount be? Then it came up to that $1,500. Obviously there are a lot of variables concerned, and various banks have different cost structures. But the reality is, and I've been out to various banks' websites, is that $1,000, $1,500, $2,000 are the limit when you look at consumer loans, when they do offer a consumer loan that's not a home equity line or a credit card. And let me say one more thing about the difference in terms of the small dollar loan or deposit advance product from a bank versus, let's say, a storefront payday loan. Any of those other loans, even the bank deposit advance product, you have to have an existing checking account at least for 2 to 3 months. To apply for the small dollar loan, you have to be an existing customer for a number of months before you can take out a small dollar loan. So how about all these consumers that don't have checking accounts right now? And they have that short-term need. Within the next 2 to 3 days, they have to pay for something. They're not going to be able to get it at the bank, even if they offer a small dollar program. So what are their options? I've been to, and I've done studies, and I've looked at, and I've actually gone into payday stores. And what's struck me as most interesting is the difference in terms of the attitude of the person who's working that storefront versus the banker in a traditional bank branch. The person in that storefront understands the consumer. The consumer has a comfort level with that person. And that person can never have been there before and then can walk out 30 minutes later on that first time with a loan. They walk into a bank for that small dollar amount. The likelihood is they are going to get a person that's not authorized to do the loan. They'll take an application. That application will have to then go through channels. They'll have to come back to see if they're approved or not. And you think about the fear of rejection. Most people do not want to have to deal with that. In a lot of communities, there's a distrust of banks, traditional banking, going into that large edifice, if you will, and giving your life story, and then saying, well, I'm sorry, we can't help you with that today.
Any questions from the audience?
My question is for Joanne. that was both heartening and, by the way, I'm John Burlock, Competitive Enterprise Institute, will be on the next panel. And that was both interesting and I would say heartening that if people were more financially literate, they had a somewhat easier time dealing with a $2,000 shortfall. I'm curious, did you do, and the professor do follow-up research on what options they used? I mean, did they go for a payday loan, other means? What were the likely options that they would use if they were financially literate, but still at the same holding income constant, things like that?
So this is, I think, research that Ana Maria and her co-authors is still working on. So this we don't know specifically exactly which behaviors that they do follow. We do know that people who are more financially literate are better able, for example, to manage their debt. So another very interesting study shows that they're more able to recognize low-cost financial products. That is a study that we've done when they are presented with a menu of different financial products. They're much more able to identify the ones that are most financially healthy for them. So that's one thing that they are able to do. And they're also more able to consistently commit to plans for the long term, which can help you actually go through a short-term crisis. So if you are able, for example, to have a long-term plan for retirement savings and you're impacted by a short-term shock, the presence of that plan or a long-term outlook can help you hold on. And that's something that we know more financially literate people are significantly better able to do.
We're also finding, when we hear from our consumers, that many of them having financial literacy in their background, being educated, college-educated consumers, as stated in the video, they find that the choice is made for them and what the options are. And the option, obviously, is, in most cases, as the statistics, is a non-traditional banking option. It ends up in the long run to not damage their credit, be cheaper, and in most cases more transparent. So that's the reality. When you have a checking account, it's much easier to go to a check casher at times, so you don't have to wait 3 days. I know recently a consumer called for assistance. It was a local consumer who went to open a checking account with his unemployment check. This is a government-issued check. They asked him to wait 9 days before he had access to his money. This is a person on unemployment. It's amazing, and that's the case, I think, in many traditional banks, not because they choose, because those are the regulations, those are what their board of directors hold them accountable to. And so, certainly when the Consumer Rights Coalition was conceptualized, I went to some of my colleagues in the banking industry, especially on the National Association of Latino Elected Official Board of Directors, and explained that we weren't out to bash banks, we just wanted more options. And he very clearly stated, this is a leading banking representative, we don't want your consumers, we can't serve them, they're a high risk, our board of directors and profit margins will now allow us to do business with them. It's a reality.
Sir, that's you.
Yeah, I was curious for Ms. Young. Is there any data on how many people are actually at risk for a $2,000 shock? I mean, in say a given year, I mean, how common is it that someone's going to have that kind of shock?
That's an interesting question, and as far as I know, that's actually a very complicated philosophical argument to make, because the question is, do people actually, what is most important? People's perceptions of their shock because of all the other unobservable variables in the environment, or is it more important to monitor their income? So we might observe that people go through an income shock of $2,000, but in actual fact, without knowing all the variables of their financial environment, is it possible for us to know if that truly represents a $2,000 shock to them? So I'm not aware of any study that goes and tries to parse at the individual level, whether or not anybody goes through a $2,000 actual shock. Objectively speaking, there are studies that allow us to see if people experience $2,000 swings in their income, which is why I think this particular measure, which Dr. Sosadi and her co-authors have put forward, actually gets more to the heart of the question: do you perceive that you would be able to get to recover from a $2,000 shock in your own estimation? And to my knowledge, this is a sort of unique measure.
I think also the $2,000 amount is relative to your income. If you're a lower to middle class working American, blue collar worker, single mother, say with a high school diploma, a $2,000 might be way out of reach, but certainly a $400 or $500 trip to the critical, care center with an asthma attack or a car breaking down or even a refrigerator breaking down would present a tremendous challenge.
Do you have any more questions for the panel? All right, if not, thanks everyone on the panel for their views and insights today. And we will just take a quick break to reset the table, and we'll start with panel 2 at 11 o'clock. Thanks so much. And we want to get started with our second panel. And now we're going to be talking about looking at the cost of credit, looking at the APR, whether it's the proper tool to be expressing to consumers the cost of credit and what the credit means to them in terms of whether there is an ability to repay, ability to obtain the proper credit. We want to introduce our panelists. We're going to start off with Professor Todd Zywicki, who is at the School of Law at George Mason University. He teaches in the area of bankruptcy and contracts. He came to the law school from the Mississippi College School of Law, where he held a faculty position since 1996. Professor Zywicki was a visiting professor of law at the Georgetown Law Center from 2004 to 2005. And during the 2003-2004 academic year, he served as the director of the Office of Policy Planning at the Federal Trade Commission. After Todd, we're going to be hearing from Janice Fowler, who is the director for the Wealth Building Policy Project at the National Council of La Raza, the largest national Latino civil rights and advocacy organization in the United States. Our last panelist is John Burlaw, who is the director of the Center for Investors and Entrepreneurs at the Competitive Enterprise Institute. Mr. Burlaw has written about the impact of public policy on entrepreneurship and the investing public for many publications, including the Wall Street Journal and the New York Times. Mr. Burlaw also is an award-winning financial and political journalist. In 2002, he received the Sandy Hume Memorial Award for Excellence in Political Journalism from Washington's National Press Club. And with that, we're going to ask Todd to come up and start the discussion.
Thank you, Suzanne, and thanks everybody for coming out today, because this is a really important issue, obviously, and we're in a period of time in which this issue is more important than ever. Everybody who's studied these issues understands how important it is for consumers to be able to get access to mainstream banking services, to get into bank accounts, for all the good things that happen from that in terms of wealth building, developing a credit history, all these sorts of things. So it's a very valuable thing. And the other thing that we've learned is that you simply cannot wish away the need for credit. That to adopt policies predicated on the idea that people don't need credit or can live without credit turn out to be very productive and counterproductive and injurious to the very people we want to help. The other thing I think is important about this is the way in which, in particular for lower income people, minorities, that sort of thing, the way in which access to consumer credit is also tied up with access to small business credit, which is that we all know the stories about people who start their businesses at their kitchen tables using credit cards and that sort of thing. And so access in a lot of small businesses are basically moonlighting consumers. And so policies that treat consumers as consumers without recognizing the heterogeneity of the way in which people use credit and that sort of thing could turn out to be very disastrous as well. Now, why is it so important right now? Well, if we had tried to sit down and devise a set of policies that would be designed to drive consumers out of the mainstream banking system and into alternative credit products, we could not dream up, we could not design a better set of policies that would bring about that effect than we have seen over the past 2 or 3 years. So I'm going to talk about unintended consequences and be charitable in doing that. But there reaches a stage, I think, where you see the same things over and over and over again, that it starts to become an open question whether unintended consequences is the right way to think of it. Now, let me say, it's also, I want to emphasize that there is a legitimate place in the financial services marketplace for the whole array of lenders that we see out there. And they obviously serve an important consumer function. But what I want to see is consumers getting the best access they can for the best credit that's available to them, maximizing choice, maximizing quality, reducing price, and that sort of thing. But at the same time, we cannot simply pretend that this whole array of credit products that we see here don't serve a function, and I'm going to talk about that at the end. But what have we seen over the past few years? First, we saw the Credit Card Act, which dramatically interfered with the ability of banks to adjust interest rates and other terms of credit card products when risk profiles change. The result has been a lot of people who had credit cards saw their credit cards get canceled. Jamie Dimon at one point said that 15% of JP Morgan Chase's customers who had previously gotten credit cards would no longer have access to credit cards. Those people still need credit. We've seen over the run of the financial crisis, $1.5 trillion of credit card lines slashed. Partly that's for other reasons, but partly that's because of regulation. We've seen new restrictions on overdraft fees, which have led to make it more difficult for low-income consumers to get free checking. Perhaps the real gorilla in all this is the Durbin Amendment, attached to Dodd-Frank legislation, which places price controls on debit cards, and basically means the end of free checking for millions of American consumers. We're already seeing new fees put on bank accounts. $3 to $5 a month seems to be the standard fee. Middle-class people will probably avoid that hit directly, but that's going to impact directly low-income consumers who are already sudden be forced to choose to pay new banking fees in order to have a banking account because of the price controls imposed by the Durbin Amendment. One estimate is that the Durbin Amendment alone will create 1 million unbanked consumers because of the fees that are going to be attached to the Durbin Amendment. And that's even before the Consumer Financial Protection Bureau comes online and starts regulating credit products still more, including the credit products that now provide the lifeline for people who are being driven out of credit cards and everything else, and the entire regulatory edifice of Dodd-Frank, which raises the cost of lending, especially to consumers. Now, when we impose regulations like this, when we get in the game of imposing price controls, imposing substantive regulations on lending products, 3 effects invariably occur. We could call them term repricing, product substitution, and rationing. So what we see is first is term repricing. So if you regulate 1 or 2 terms of a loan product, the first thing that happens is you try to adjust other terms of the lending product. So back in the 70s, for instance, when we had very strict usury regulations in many states, well, that was what created basically the advent of annual fees on credit cards, was that credit cards got annual fees because you couldn't charge a market rate of interest. Now, annual fees are an unusually pernicious form of term repricing because they're basically a tax on holding credit cards. So they dramatically stifle competition in the credit card market. So, for instance, I have 4 credit cards in my wallet because I don't have to pay an annual fee. If I had to pay an annual fee, I'd carry 1 credit card. I'd have a lot less choice. Right now, the credit card issuers compete for my business every time I stop to make a payment. My credit cards are competing in my wallet right now. And the only reason that is going on is because I don't have to pay an annual fee in order to hold a credit card. So that regulation of interest rates led to annual fees, which stifled competition and consumer choice and quality in the credit card market. The second thing that happens is product substitution. So for instance, if you are unable to fully adjust the terms of your credit product, what happens is that for some consumers it no longer becomes available. So, for instance, again, states that had strict usury ceilings, interest rate ceilings in the 70s, saw this. So, for instance, Arkansas, state of Arkansas had the strictest interest rate ceilings in the country, 10% on everything. Almost nobody in Arkansas could get a credit card. Arkansas was also the pawn shop capital of America. Pawn shops were about 3 times more common, adjusting for everything else in Arkansas, than in other states that had similar sorts of things. We're seeing that today. As credit cards have become less available, consumers are switching over to motley things like layaway. They're making more use of pawn shops and payday lenders and everything else, primarily caused by ill-designed regulations of credit cards. So product substitution basically knocks people down their preferred credit ladder to less attractive and less preferred forms of credit. The third thing that we see is rationing, which is basically some people will have to do without credit. Now, that's believe it or not, the good scenario that people do without credit. But if your transmission breaks and you need $2,000 to fix your transmission so you can get to work on Monday so you don't get fired, you still need $2,000, whether you got it in the bank, as the last panel was talking about, or whether you have a credit card. You need that money or you're going to lose your job, right? That's a reality. If you need money in order to keep your check from bouncing or your electricity from getting shut off, you need that money, and we can't just wish that away. Now, what we've seen historically is that either consumers suffer when they don't have access to credit, and we've seen papers come out by Darren Morris and others that have talked about the benefit of, say, payday lending in communities that have been even hit by natural disasters. But more generally, what we've seen is that's when the loan sharks come to fill the gap. We don't have a lot of good data, obviously, but the reports are that in the 1960s, for instance, loan sharking was the second largest revenue source of the mafia, behind only gambling. And at the time, enlightened consumer advocates in the 60s and 70s realized that you couldn't just wish away the need for credit, and instead we needed to be able to compete with credit and give consumers a choice and that sort of thing. And that's the sad part about all this, as far as I'm concerned, is we know how this story ends because we've seen it played again and again in American history. At the beginning of the 20th century, we saw this great migration into the city, from the farms and immigrants coming in to fill the jobs in the factories in the big cities. And what they soon discovered was that those people needed credit. They needed small dollar, short-term credit in order to meet their living necessities. And what happened was we had an old, antiquated, Victorian sort of approach to credit. The overall result was that loan sharking proliferated in the big cities in the 1900s and the 1910s. Beginning in the 1920s, innovative consumer activists, working for the Russell Sage Foundation and others, realized that people needed access to a small dollar credit and started coming up with ways to spur competition and that sort of thing, and get people out of the black market and into more legitimate credit products. The response, unfortunately, one of the responses to the Great Depression was a lot of people thought the Great Depression was caused by too much access to credit. And we saw a crackdown on substantive regulation, stricter usury ceilings, stricter barriers to entry on consumer credit in the 50s and 60s, such that we reached the point that I just described a minute ago, where basically we had driven people back into the underground economy, back into the arms of the mafia and the loan sharks, which then led to the deregulation moves in the 70s and that sort of thing. And I fear that what we're going through right now is this same historical cycle, which is a belief that we can simply wish away the need for credit, impose substantive regulation on credit, and somehow consumers are going to be better off with less choice and less competition, which would be a very unusual economic model if that actually held. So where does that leave us? I want to say, the last thing I want to say then is that what I'm disappointed about for the past few years is that I believe we've missed a great opportunity to actually improve our consumer credit system, which is that we had the right idea in the 70s when they introduced things like APR, of standardized disclosure-based regulation that could promote competition and consumer choice. Over time, we've accreted that with so much litigation and such bureaucratic and regulatory burdens. The Truth in Lending Act was 3 pages when it was originally introduced. Now the regulations for the Truth in Lending Act go to thousands of pages. As we've just piled more and more litigation and more regulation on that, we basically overwhelm the system. The problem is that the response to the financial crisis has been more of the same rather than looking back at what consumers really need and how we can do it. So the last thing I'll leave you with is 2 ways of thinking about regulation. One we could call market reinforcing regulation, one we could call market replacing regulation. What we see coming out of the financial crisis is more and more market replacing regulation. These same failed experiments that we've seen for at least a century in the United States of trying to regulate the terms of credit, reducing competition and consumer choice, and thinking that's going to make consumers better off, and it doesn't, and it won't this time. What we should be thinking in terms, I think, instead, is recognizing, as we heard from the last panel, consumers, poor people know how to be poor better than bureaucrats in Washington, right? And we should recognize that we should help people make their choices, we should help with consumer literacy and that sort of thing, but let's not treat people like children. There was a famous story, during the 60s when they were doing these interviews and this sort of thing about how poor people use credit. And finally there was this one, Ivy League economist talking to this poor woman on welfare. How does she spend her money? Trying to figure out how she wastes her money and that sort of thing. And finally she said, look, if you want to talk to somebody who wastes their money buying things they don't need, you better go talk to the rich people, because if I did that, I'd be dead. Right? And it was a very sobering experience for that particular Ivy League economist. But I think there's a kernel of truth in there, which is that what we're going to do is help people figure out what they need, make them use it, help them to use it better, but let's not treat them like children and trying to replace it with substantive regulation and the like. Thanks.
Especially fiery and passionate. I don't know if I can quite match that, but I'm going to give it a go. So my name is Janice Fowler. I'm the director of the Wealth Building Policy Project at NCLR. And for those of you not familiar with National Council of WRASA, we are the largest Hispanic civil rights organization in the country. And my policy project in particular focuses on helping low and moderate income Latino families build and maintain assets that are going to last them over a lifetime that they can share with the next generation. I have to tell you that having a title like Director of the Wealth Building Policy Project in this economy is really, really tough. Most of our folks are not focused on building wealth or assets. Most of them are just surviving day to day. It's also likely that both of my esteemed colleagues know these regulations forwards and backwards, can recite page numbers in their sleep that I cannot do. So I'm not going to try to outdo the dialogue on the regs. But what I thought I would do is share with you a little bit about where the community is at right now and the kinds of experiences people are having and some of their challenges in accessing credit, and then maybe some goals for policy around that. So some general facts, most that are not lost on people in this room, I'm sure, but when we look at Latino and African American communities, we're talking about double-digit unemployment for the last 3 years, record foreclosure rates. California alone, Latinos are half the foreclosures. And we think about foreclosures in terms of the loss of the home, but chances are an entire financial safety net has gone with that home. Families are exhausting their savings, their retirement, if they had it, before they actually lose that asset. So that gives us a pretty clear picture of where people are at, and it's not good. So let me start by a couple of areas where I really agree with Todd and some of the points that he was making. And one is that people in this situation often do need credit, and it's often not pretty. And so there's this paradox for families in dire straits, right? The more you need it, the uglier the credit is. And so one of the things that we're thinking about is not, how do we cut off the spigot for people in vulnerable situations, but how do we make sure that the credit flowing to people in those vulnerable situations is transparent, that it's fairly priced. Notice that I didn't say cheap. Emergency credit is not always cheap, but if people do have real choices, and I'll talk a little bit about what I mean by that later, and if there is real innovation going on in the market, then they should be able to get access to something that helps them out in a pinch. The other thing that I think was really important that you said, Todd, is that when we have a vacuum, we know that the predators move in. And that is especially true in communities of color and in immigrant communities where they are more isolated from the financial mainstream. And so I spend a lot of my time beating up on the mainstream financial institutions and saying, why aren't you out there competing with the predators and putting a good product out there that will give them some real options? And again, I'm alluding to choice, and I will come back to that. So just as a general framework, I think our approach to this is very pragmatic, and we really want to work with folks to think about what is the right regulation that's going to promote innovation and is going to deliver credit to people in a way that is transparent and is fair. So I alluded to this a little bit, but let me kind of walk you through what we see as a sort of three-step process as a goal as a community practitioner and a community advocate. I mentioned, people have this real need for emergency credit. I mean, this is basic hierarchy of needs, right? If you're financing diapers on a credit card, or you're going to a payday lender to make sure that you've got groceries, you're in a pretty desperate situation, and families have to cope with that. They have to eat, and that's not always pretty. So we want to create tools and opportunities to address that immediate short-term need. The next thing we're looking at is then how are we going to help families recover, and what are their opportunities to save? And that's something else that's really important in the spectrum of credit. Once people are back to being gainfully employed, when they have income coming in, chances are their credit score is in the hole. There's no way you go through this and come out with a clean credit score. So what are their options for stair-stepping back into responsible, more affordable credit, and sort of graduating back into that sort of A+ credit? And then lastly, we're looking at that long-term savings, asset building, and financial security. And there very well may be different products that kind of meet people in those various stages. So one of the things that we were asked to talk about is APR. So I'm not going to lie to you, I feel like that is a little bit of a rabbit hole to get into APR. But let me just say this about it. APR is certainly a blunt instrument, and when you're talking about the kind of immediate short-term credit needs that families have, as I described in this first scenario, no question, blunt instrument. But what I think APR does add is, right now it's the only mechanism that we have to give families transparent shopping options. It's their only way to create apples-to-apples comparison. And so if we want to talk about a different way to do that, happy to have that conversation. But right now we don't have another mechanism that's going to allow families to make those kinds of choices. So if we think shopping is important, we all talk about real choice often enough, then there's still a role for APR. So the other reason why APR is really important is because short-term credit usually is not actually short-term credit. Most people that are in emergency situations that need emergency cash, $300, $500, the chance that they're going to be able to absorb that in their next paycheck, slim to none. So they're going to have to roll that over. And if they roll it over a couple of times over the course of the year, if they're taking that loan out 6 times over the course of the year, now APR does start to get to be closer to a more accurate depiction of that cost of credit. So starting to think about choices, one thing I was thinking about, Todd, when you were giving your talk is a real choice for a family in that situation would be a repayment plan, something that allows them to get access to emergency credit, but spread that payment over several paychecks so that they have a real, if it truly is emergency and they really are going to be able to absorb it over the next paycheck, God bless you, you're probably managing your finances better than I am. But if not, having a way to pay back that loan over a period of time is a good thing. And in fact, when we've talked to consumers, I would venture that most of them who need emergency credit would prefer a short-term loan with a definitive end date than even a revolving credit card. Because actually a lot of consumers like putting their own guardrails on themselves. And so knowing you need to borrow $500, knowing what happens with credit cards, wanting the money but wanting to pay it back in a reasonable amount of time gives them a way to do that. So that leads us to products. And so we spend a lot of time, especially around these halls and inside the Beltway, kind of debating the regulations or debating the way we depict costs, thinking about things about APR. But I don't think we spend nearly enough time talking about the way that policy or the government can help create innovative financial products. In some cases, that might mean getting out of the way. In some cases, it might mean putting some money out there to try to help some experimentation, funding loan loss reserves. There's some of that going on at CDFI right now. And that, I think, actually could be really helpful because we're stuck in a rut right now. We're seeing some companies really step up and innovate. I know that you guys are going to hear from my friend James Gutierrez later this afternoon, and I don't see him here yet. He's somebody that has a really great product. I think you guys will benefit from hearing what he's doing. Banks are starting to try to crack this nut as well. But really, to be honest, we could use a lot more thought and energy and innovation going into this area to think about how do we get people who are in dire straits credit in the most fair and responsible way. So let me offer my take on a couple of ways that we can, what some elements, when I say fair and responsible, right? I know there's lawyers in the room, and those are very vague terms, and those are the kinds of things that make you uncomfortable. So let me give some suggestions of what I've seen as best practice amongst the innovators out there that I've talked to. One is underwriting. Just because it's emergency doesn't mean that you can't underwrite the loan, even if it's a short-term loan. Making sure that the family has an ability to repay is important here. Even if it's an emergency, there's still a way to extend that credit in a responsible way. And I offered up the suggestion of a repayment plan, which I think allows you to spread the cost over a period of time. There's still a way to do that and be profitable. Nobody's saying that these companies shouldn't make money for the risk that they're taking here. But it gives the family more flexibility to cope with an actual emergency. And then as a general rule, no asset-based lending. We heard this term applied a lot in predatory mortgage lending. But when we think about, direct deposit advance products or payday loan products, the real heartburn here is that the only mechanism for, or I shouldn't say the only, the business model for many of these products is your next paycheck, which has nothing to do with examining the totality of circumstances that are happening with that family. It's just strictly based on your next paycheck. And so if that's the only judgment there, then it's asset-based lending, and that's not a good way to do it. The last thing that I'd mention is thinking about consumer education as a way to help families make good choices and make behavior change. So if in the Q&A anybody wants to get deep into this, I'm happy to, but let me just kind of preview by saying that our old way of thinking about financial literacy with tons of courses and a workbook and homework, not the way we do financial education anymore. Best practices, you teach to the tool at the moment that people are making decisions. So we've been experimenting with a model that would put financial planners in community-based organizations, so that if you're going to get a car loan, you visit somebody and you talk about car loans. If you are in a bad situation and you need emergency credit, you talk to somebody who can help you evaluate your options. Quite frankly, it's not that different than what most of us in this room do. We've got money questions. We go ask a financial planner or a personal banker or somebody else who knows more than we do that can give us the advice tailored to our specific question. So I'll close by saying that I think our real public policy goal for regulations should be giving the good guys a fair shot. A lot of what we've seen over the years in the credit market is that the bad practices really have overshadowed the good guys, the guys that are innovating, that are trying to get their product out there. But the bad guys tend to crowd them out in the market. So if we can give the good guys some more airtime, if we can craft regulations in a way that allows for some innovation and some protection and some guardrails, then that's the win-win. And if you can do that, you get the gold medal of diplomacy and bureaucracy. Thank you.
Well, it is a pleasure to be here. I wanted to thank Alvin and everyone who helped set up this conference. We're glad to be. I'm glad to be a part of it, and thank you all so much for coming on a rainy day like that. And Janice, I would keep the title of the Wealth Building Project. It's a good title, and it's the right way to think about these things. Because the question we should be asking is any community, how do you build wealth? How do you achieve the American dream? Wealth isn't something where there's a fixed amount and you can redistribute. Wealth is created. And that's sort of been my focus, both as I started out, as Suzanne had said, as a financial journalist. And also when I was a correspondent for Investors Business Daily, I had the privilege of interviewing John H. Johnson, who was the founder of Ebony Magazine and Johnson Cosmetics, has passed on now. I had interviewed him in the late 90s. And he actually got his start with by actually pawning his mother's furniture for $500. He started Negro Digest, the magazine that would become Ebony. So, and it's still going strong. So every time you see a ban of a consumer product or something that makes it hard, that is a regulation that goes beyond, say, disclosure or fraud and actually limits people's choices, you're not only potentially making it harder for a consumer to afford products they might want or get something their family may need, but also potentially limiting the opportunity of an entrepreneur to start his or her own business. And of course, and the C in Competitive Enterprise Institute, where I am now director of the Center for Investors and Entrepreneurs, is competitive, competition. And we look at all different ways. Like say, and we think it's great, to have both, banks, credit unions, and non-banks lenders competing with each other for consumers and entrepreneur services. For instance, with the credit unions, we're saying positive things now about a bipartisan approach, the Small Business Lending Enhancement Act, that lifts this ridiculous ban on credit union business lending that says that credit unions have to limit their business lending to 10% of their assets, and which is ridiculous. There's not a safety and soundness rationale, and they can make as many, there's no such cap for consumer and auto loans. So there would be more competition for business loans for entrepreneurs in this way. But I think also the Durbin Amendment, which affects both community banks and credit unions, as well as ending free checking for limiting free checking for consumers and entrepreneurs, all for a big transfer of wealth to giant retailers like Walmart. I think in this area of small loans, alternative lendings, it's a sensitive area. It's an emotional area, but it's also one of, as our two panelists were saying, one of the most important areas, and it's important not to get wrong. And in this level, I mean, we're talking about federal regulation. The states have not proven to be citadels of wisdom either. And the annual percentage rate measurement needs to be, if this is going to be what states base legislation on as far as interest rate caps, things like that, it certainly needs to be broadened, and other measurements need to be used, because as far as competitive products, we need to look at who things like payday loans and pawnbrokers are competing with. Their competitors are late fees, are overdraft fees, are over the limit fees on credit cards, and these have been shown by Federal Reserve studies. A recent study, most recent by Kelly Edmondson of the Federal Reserve Bank of Kansas City, have that payday loans, as demonized as they are sometimes the most now this doesn't mean they'll always be. I mean, the direct deposit advance, I mean, I welcome, I mean, you know, competitive products like that. But measuring some of the products of recent years, people had complained and put a 36% cap. Says these payday loans are 400% interest rates. Well, if you look at an over limit fee, that might be 1,000% APR. And Kelly Edmonston in the study published by the Federal Reserve Bank of Kansas City found that it might be some bounce check fees might represent 4,000%. And the answer is not to ban any of these products, but to make sure disclosure is adequate and in the best, and you know, allow these products to compete, because you're really, otherwise you could really be cutting off the rung of an economic ladder. And say the $2,000 study that was mentioned before, that's the price. I think the study goes into that's the price actually of a transmission. And you know, it may not be an entrepreneur like John Johnson, but you could be having somebody who's a plumber who is, the president mentioned plumbers yesterday, so I'm going to do too. So that, you know, is driving a truck around, and then they lose you know, lose that transmission. I mean, they need that truck, you know, be up and running every day for business to get to the homes, and you just, you know, you may potentially be putting them out of business. Another interesting thing about the Edmonston study is that it shows that a lot of times consumers will seek out alternative lending, even if they have checking accounts, even savings accounts sometimes, for their credit standing. You get a payday loan or some other type of alternative loan, and it's typically not reported to the credit bureau. So if, you know, years down the road you're planning, you know, on borrowing for your business, on borrowing for small business, and one of Jerry's presentations before, in the panel before us, we had a small business woman. It doesn't go on it doesn't affect your credit score, whereas a late payment or an overdraft would likely do that. So this is, we should, you know, consumers at all levels of income. I mean, financial literacy doesn't have to do with your income level. We should treat consumers as if they're smart, and you know, work on financial literacy and education programs. And I think also one of the things I'm encouraged by is some, you know, competition among, not just among businesses, but among the federal and state governments can be a good thing, as Martha Stewart would say. Todd mentioned the disappearance of the annual fee and credit getting cheaper. That was in part because of the National Bank Act and the Marquette decision saying that you could issue a national bank could issue a credit card from any state, and you had things because they were in states with, you know, flexible regulatory environments, you had things like annual fees disappearing and more rewards for consumers. Of course, the Durbin Amendment, wealth transfer, price control at the retailers are affecting rewards and things like that. But one of the things I'm encouraged by is there's a bill called H.R. 1909, a bipartisan bill. Joe Baca, Democrat of California, is on it. You also got Gene Schmidt of Ohio, but I think I have a handout about that. That would create an office in the Comptroller of the Currency, for non-bank financial services, and would give, like banks have, an optional federal charter to these institutions, so that they could choose whether to be regulated by the states and the feds, and then consumers could choose the same kind of thing we have for banks and we've recommended for insurance. And I think, you know, keeping the sovereignty of the consumers in mind, consumer choice, even and I should say especially in situations such as this, that letting consumers, you know, with talking with their families, with their church or synagogue, making decisions like this is absolutely essential. And I'm happy to take any questions.
Before we open it up for questions, I think Todd wanted to make a couple of comments.
I really enjoyed both those presentations, and just wanted to really just elaborate on something. First is, I just wanted to make sure that people didn't miss. I thought what Janice said about financial literacy was exactly right and really on target about, and I looked at signs of the FTC, the need for better ways of doing financial literacy and doing financial literacy at the moment people are making decisions and they're focused on and that sort of thing. And I was just, that's great. I just thought that was just a great thing to hear. Second thing I just want to say was about APR, which I didn't say much about, APR can be useful as a shopping tool, yes, for helping people to compare things. And that was the idea of the Truth in Lending Act. The problem is we've taken APR, instead of using it as a shopping tool, we've used it for prescriptive regulation. And it is way too blunt to say a 36% APR is the highest that you can charge, right? It's not designed to do that. It's designed, as Janice said, to promote shopping, not to do prescriptive regulation. Number one. Number two, what we've heard again and again this morning is people shop on margins other than just price. They shop on convenience. They shop on things that are open 24 hours. They shop on how fast they can get the money, right? They shop for payday lending because they don't have to worry about their credit score, right? And payday lending is cheaper than a bounce check. Sometimes overdraft is more expensive than a payday loan, but at the same time, overdraft is even faster. You can use overdraft at the point of sale, right? I mean, there's all kind of different margins on which people are shopping. APR is just such a small part of it and such a blunt tool that we get in trouble, I think, when we use it for a prescriptive tool rather than as one of the tools for people in order to make sophisticated shopping. Final thing I want to say is just about competition, which is first, the need for new providers of credit. One of the things that I thought was appalling a few years ago is when all the big banks got together and conspired to keep Walmart from getting an industrial bank charter so that Walmart could enter the consumer banking industry. So I'm irritated at Walmart for the Durbin Amendment, but I'm totally with Walmart on the need to be able to compete in consumer retail markets. And what we see is Walmart's entering that market very aggressively anyway, but in a more limited way. The final thing I'll just say is stress the heterogeneity point, which is I was thinking about John's example of the plumber. I did a paper a few years ago on auto title lending, and what I discovered was that auto title lending is often what title lenders report is about 30% of their business base is small businesses. So and it's used as a source of operating capital. So like a landscaper who works primarily seasonally doesn't need a small business loan in order to be a landscaping business. But what he'll do is he'll get a job. He'll take his pickup truck, pledge it to the auto title lender, use it to buy the sod and the bushes he needs, go do the job, get paid in 3 days, go back and repay the auto title loan, right? And you can prepay auto title loans and everything else. It's a perfectly reasonable and kind of savvy business model to think about financing the operations of something like a landscaping business in that way. It's not obvious that there's a better way of doing it. But if we just think of auto title lending as just some sort of predatory consumer system, we're going to miss the different ways in which people use these sorts of things. So it's a very complicated sort of question.
Thanks, Todd. And I also wanted to follow up on this notion of the APR as a shopping tool. And as we all know, the CFPB has taken over the Regulation Z. And assuming you are on the staff and you are tasked with creating the, know before you owe disclosure for payday loans, do you include the APR? Do you not include it? Or what elements do you include to make sure that consumers have an understanding, transparent nature of the cost and are able to shop?
Yeah, that's a good question. APR is almost uniquely useless in the context of a payday loan. If you're going to think of a product in which APR was absurd, that would be it. And I'm totally granting Janice's point that a payday loan is often more than 2 weeks. So I'm not setting that aside. The reason I say that is that it is very clear from the research that payday loan customers have no idea what the APR is and know exactly how much a payday loan costs. And everybody knows that a payday loan costs $15 per 100, right? And it couldn't be simpler than that. And so in that sense, to try to shoehorn, and that's really simple, right? $15 per 100 is even simpler than any sort of APR measure. And so I think it's a good example. Consumers understand what's going on. They understand how much it costs. The competition in that market tends to be on non-price terms, right? It tends to be on convenience. It tends to be that sort of thing. Consumers, competition does seem to make some effect in the studies, but primarily consumers are choosing on different margins. So you just kind of lock it in and think of it from that APR thing. I think it's just a bad idea. How would I do it? I'd have to think about that, but I know it doesn't look like trying to shoehorn a product where people already know the cost into a completely foreign concept for them.
Consumer wise. Thanks. Sure, absolutely.
So if anybody was worried, there was a lot of agreement on the opening comments. I won't let this unravel into a love fest, so let me push back just a little bit here. So I don't see anything wrong with putting if I were there, the know before you owe box, putting APR out there. I think you're right, consumers shop on the basis of a number of things: convenience, language, cultural competency, who can turn the money around fastest, and yeah, maybe they also look at the 15 on 100, in which case having the APR there may be helpful for some people, and it's not a bad, it doesn't hurt anybody to have it there, but what it does do is set some context that I think is helpful, and I would relate it to the new figure on credit card statements, where if you continue to pay the minimum balance, it's going to take you 20 years to pay this off. A lot of companies, there's a lot of squawking about that at first, but it sets the context for the customer so they can say, okay, I understand this. That doesn't, they're still going to make the decisions they need to make for their family, but it gives them a piece of information that allows them to think about this in the context of their options. 15 on 100 is pretty easy when we start looking at 20 on 250 for 4 weeks versus 2 on the 20 for a direct deposit advance. This starts to get to be really higher math when we're no longer talking about apples to apples. It makes it hard to put it in that context. But I would really agree with your point about, or John, maybe you were making this point about, APR has to get broader, because if you compare these things to an overdraft fee, for example, that really does put it into context, because that's a very expensive product.
Let me ask a question about overdraft fees, but they don't disclose APR. And when I was putting those programs in, I said, your direct competitor with overdraft is a payday lender. And you're not disclosing apples to apples on that. So open up to anyone on the panel, but what are your thoughts about, we don't disclose on one, why would we disclose on another?
I say disclose on both.
Yeah, I would say two things. First, which is by and large, what the research indicates is that in choosing between payday loans and overdraft, people tend to choose rationally, which is that they are two completely different priced products, which is on an overdraft fee, you pay a flat rate regardless of how much you borrow. So basically, it's more efficient to take an overdraft if you've got a large payment. And that's tend to be how, in general, consumers use it. For payday loans, if you're taking a smaller loan, then it makes more sense to have a payday loan because it's tied to the size of the draw. Does that make sense? Does it make sense to have one disclosed as an APR and not the other? I mean, I think it's equally stupid to calculate an APR for an overdraft, perhaps even more so, because unlike overdrafts don't get rolled over, or almost never get rolled over. Most overdrafts get repaid in 5 days or something like that, right? The annual percentage rate on a 5-day loan, really? I mean, is that really very useful? Even less useful, I think, than a 2-week loan. So I take the point. I do want to say one last thing about disclosure, though, because Janice raised one of my pet hobby horses. So I can't let it go, which is because it shows exactly the wrong-headed way in which we've thought about consumer credit regulation over the past 10 or 20 years, and how we got in this pickle where TILA is thousands of pages long, which is the minimum payment, how long it would take you to repay your outstanding balance on a credit card by making a minimum payment, is a classic example of unhelpful consumer disclosure, which is, it's what I call normative disclosure, which is it's disclosing to consumers not what they want to know, but what bureaucrats think they should know, right? Now, how do I know that? Well, according to a Federal Reserve study that was done, they asked the question, how many consumers would want to know, first, how long it would take them to repay their outstanding balance on their credit card simply by making a minimum payment? And second, more importantly, would you be willing to stop using the card in order to do that? And the answer is, at most, 4% of consumers said that they would consider those two pieces of information, right? So we are now requiring a prominent disclosure on everybody's monthly statement of something that is of interest of, at most, 4% of American consumers. Now, we may think that's a good idea, but it's not a good idea because it's helping anybody. It's a good idea because we're trying to change people's behavior by using disclosure, and essentially we're just doing backdoor substantive regulation. And when we start requiring some things to be disclosed, especially things that are irrelevant to most people in that sort of way, it makes it more difficult for people to get the information that they want in that sort of thing. And so I think that's kind of an example of how we get your sort of regulatory creep of disclosing more and more, making disclosures less helpful for consumers and in that sort of thing.
I would just add, I don't think it's necessary to disclose the APR for an overdraft fee. An overdraft fee is really the technological successor to the old bounce check fees, and most people know or should know you don't bounce a check, you don't go over your account. So people who are using overdrafts as loans, and that's one of the innovative features, I think that local competition are thinking about, that the fact that they're using it as loans. So I don't think it's necessary. Although I don't think you've been shown this. The Federal Reserve studies and others have shown that when you ban payday loans, there are more overdrafts. So the products do compete, and the costs do go up when you ban one product. So I think let both compete, but I don't think since overdraft or sort of I don't think a disclosure for the APR in that case is necessary.
Actually, anyone can answer this question. It's for Janice. I'm very interested. I think my consumers would be on this whole concept of asset base. The only thing some of my consumers have is their work ethic and the fact that they've been on the job for 15 years. That paycheck is their asset. And the way we talk about small businesses, that truck that they own, that's the only thing that they can use as an asset against a short-term online piece-slip loan. So what would they consider, especially since some of my consumers either have bad credit or they don't have credit history because they're used to dealing paycheck to paycheck, cash to cash.
Sorry, I can't see
I know.
completely here. And this is going to sound like I'm punting, and I'm only punting halfway. In part, I think that that some of the businesses out there that are innovating in this space can probably explain it a lot better than I can what their underwriting process looks like. But the difference between you can still underwrite looking at consistency of income over time. I would not consider that asset-based necessarily. So one thing I've seen, for example, is even if it's not every 2 weeks, but over the course of the month, you're regularly bringing in this amount of money, you check bank statements, you see that they've got this, maybe they have a community that they're tapping that is also a cash reserve. Those are innovative ways to judge the totality of somebody's experience. Versus we are going to, the classic payday model, which is I'm just going to hold you this check and cash it on this day without really looking at that totality. So you don't have to pull a credit score. I would not necessarily recommend that. I think there are better ways to do that. You can also look at history of repayment on other things like utilities, remittances is another good one. I mean, talk about savvy. You're looking at, you know, immigrants living at the poverty line that still regularly send $300 back a month. So what I really mean is looking at the totality of a person's experience, of their financial situation, and then making a lending decision. And I do think there's companies out there that are figuring out ways to do this that really makes sense for people. That's not just, I know you've got a paycheck coming, so I'm going to immediately take that money out next paycheck regardless. It might be better for somebody, as I said, to go on a repayment plan. If you look at the totality of their experience, that might be a better setup for them. And you can help nudge people in the right direction in that case.
Can I just add a word? Because I really like that question. And one of the things that's interesting to me is, again, when I worked on auto title lending, for most consumers, after a credit card, their most preferred form of credit is a payday loan for most people. The problem is that, especially for immigrants and a lot of others, they don't have bank accounts. And you have to have a bank account in order to get a payday loan. So I think that the point is a good one, which is for those who are unbanked, often immigrants are a portion of that subset, the only credit they can get is asset-based because they can't get a payday loan because they don't have a bank account. And so basically they're looking at pawn shops and auto title loans. And obviously asset-based lending like pawn shops and auto title loans raise serious questions that something like payday loan doesn't, but it's a good example that it may be the best that they can do if they're unbanked. Obviously the solution is to get more people into bank accounts, but I've already covered that.
And Janice, if I email you, do you have any information on the companies that are looking at the innovative ways?
Yeah, I can send you a couple of examples of people we can talk to.
On behalf of my consumers, I wish they would base it on your character and your ability to make, go to a job, get up every morning, and go to a job and put food on the table for your kids and work through that model doesn't exist.
Anymore.
Yes, absolutely.
I wanted to add, and Janice has mentioned repayment or installment loans, and I think those would be a good idea in some circumstances. One of the problems is that loan providers aren't allowed. It's either payday or installment, and one of the things that say an office inside an optional federal charter would do would be allowing certain types of innovative new products that might better serve borrowers.
Great point.
Okay, with that, we want to say thanks to our panel. We are going to break for about 15 minutes, come back in this room about 12:15, and we'll have lunch actually in this room. Okay, thanks everyone.